Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Tradier brokerage account. Today on the show, we're going to be showing you how to backtest double calendar spreads in the updated ORATS dashboard. Matt, do you want to share a screen and get us started?
Sure. Yeah. The new dashboard looks great. So when you come in, this is the welcome. If you ever want to get back to it, you just click on the ORATS O. To get to the welcome, people like that we're like organizing the tabs. So today we're going to talk about the custom backtester, and then you can then save them in your save backtests, and we're going to show you some other things too. If you implement it, you would go to the options scanner and eventually the options chain. And then we have some risk management where you could look at the positions that you have on, look at your trade journal and some other things. And then in the review, you could look at what's going on in the market, trade history, etc. We have a community where people could ask questions and you could comment. Blog, university, and auto, of course, is a key instructional auto AI to help out with questions. So like I said, today we'll be going into the custom backtester, so you can get it that way. I've also pinned this tab, so it makes it so you can get here quicker. And then you notice that there's just a basic one that just has kind of strikes and DTE diffs, etc. And then there's also the advanced end of day, and we're also working on an intraday that we'll be releasing soon. So so far okay, Tyler?
Yeah, I like all these new features, and yeah, we showed off kind of this new dashboard last week and a little bit of the advanced backtester. We had a show on it, but yeah, we're going to dive deeper into a particular strategy which has been of interest to a lot of our users, which is double calendars, and it's a fascinating strategy, and I'm excited to go over the risk profile and some other neat things and why you would trade this, what kind of environments it's good in, and that kind of stuff.
Yeah, that's a good point. So, and one of the reasons that we wanted to show this was, a double calendar. We don't have it on our drop down typical calendar or typical strategies. So, one of the cool things about the advanced backtester is the ability to create other types of strategies, and so that's what we're going to show you. Eventually, we will add the double calendar into our strategies, but
I think it is in there, man. Yeah.
Okay.
I just added that a few days ago.
All right, I did not know that. Well, anyway, I'm going to show you how to make a different one, and including a double diagonal, and we'll talk about all that. So, so let's dive in. Let's go into the double calendar here, and so you could see that there are the default is 90 days to 30 days, and the strikes is at 30 deltas. So that's a fairly typical double calendar. And what you're doing is you're buying a long term. People might be familiar with a calendar, just a typical calendar, where a call calendar or put calendar. And I guess what we could do is talk about how those structures look. Do you want to do that first, Tyler?
Sure. Yeah.
All right. So, again, I like to go here. That pulls up all my types of tools, and then I like to go to the risk profile here. So the risk profile will show you how to set up and how to look at particular strategies. You could pull it up that way, or you could go to your positions and pull it up from positions. For example, I have various positions on. I could pull it up from there. I could pull it up from the trade sidebar that comes up. So there are various ways that you could look and get to the risk profile right now. So we'll wait a little bit. Market's opening. Things are a little slow on my internet here, so we'll kind of give it a second to pull up. But until then, yeah, I could view all my the latest thing in the risk profile is looking at all of your positions. Again, it's a little slow right now, so we'll go back to the custom backtester and kind of look at that. So one of the important things with a double calendar is that you will constrain how you want that to look. So you have entry parameters where you could set days and how far back to go, but then you could also the important thing with a double calendar are the leg relationships. And what does that mean? So you'll look at like leg 1 minus leg 2, and you'll see that 30 minus 90, so that's going to be negative. So you want the maximum to be negative and the minimum to be undefined, but below that. So and then legs 2 and 3, those are going to be different. Those are constrained by deltas, and then you do the same thing for the put. So 30 minus 90 again is negative. So you'll have the DTE difference will look something like that. We're going to ignore the delta, because you could also do instead of strikes, we're going to look at strikes, but you could also do deltas. But let's do strikes today. So you'll notice that legs 1 and 2 have a minimum difference of 0. And you could always put the informational icon here to tell you what that is. But it's basically leg 1 minus leg 2. So we want that to be 0. So that means that they're going to be exactly the same. So you're going to have 100 strike that you're long, and then a shorter term 100 strike that you're short. And that's what a calendar is. And a double calendar is just having the puts look that way as well. So that's how that looks. So now we could just run this so this is running SPY with the defaults, right? Then after so this is running, and you can see that it's going to run. It takes a minute to run. And then, you could always go in and then change, some of these DTEs. Now, you'll notice that it's just changing part of it. So you'll have to then still go in and set the longer term versus the shorter term. And you could also, change the strike selection as well. So, what we might want to do is just go in and, choose the double calendar again. It has a 90-30, but then we might want to move the deltas down. So move it from 30 down to 20. So that, and then we'll test that. Okay. And then what we might want to do is test, going the other way, going from 30 up to 40, and run that back test. So you can see how, this particular platform allows you to, do some what if analysis, and you can kind of hone in, where you want to be from a delta perspective. And you could even do this from you could make this 15 days and go like 7. We like to have a pretty wide range, but like 15, 7, and 21. So we'll be able to look at this one in terms of where that might finish up, with a slightly different day relationship. In this case, short-term one. Any comments so far, Tyler?
Yeah, thanks for explaining the leg relationships. I think that's a pretty common thing for people to get hung up on. But yeah, if you select it in the default strategy list, it will auto fill that in for you, so you can Well, what I like to do when I get confused on some of this stuff is I go through the defaults and select things and see what the default selected, so that I can make sure to kind of not make my own mistakes and just sort of see, oh, am I missing a default parameter like strike width? There's something important here.
Right, and you'll see, like, if it doesn't run, if you get no results, then
Right.
then you'll you're doing something askew.
Yeah, you have one of the annual return. The annual return will show up as a little dash in the row, and that's when you know something's wrong. But it looks like yours ran. So yeah, let's take a look.
Okay, so here's the first double calendar. This is the default double calendar, so let's click on it. So what you'll see first is the graph, and the graph doesn't show that much here, meaning there's not much movement. That's because we're showing only 20% of the capital used, and this is a type of strategy that doesn't make a whole lot and doesn't lose a whole lot. And to kind of prove it to yourself, you could look at some of the returns that you'll get. Like, so if you go into the trade log here, you could see some of the trades that you made. And if you go all the way down, you can see the last trade that you made. So we have this updated up to for 2025. And you can see that, indeed, some of these are pretty small profits. So what's going on here? So we'll just look at the last one with SPY at 681. You did a Jan 60. Oh, that's because let's not look at that one. Let's look at the ones above, because those are stopping at the end of the year. So let's go up to the top and see ones that actually might finish. And matter of fact, you probably have to go or no. So you could start with there. So back in January of 2025, when SPY was around 600, 598 to be exact, you did the 613 call, so out of the money, and these were right around the 30 delta. So you see 29 delta and 30 delta. And then you did the puts. You did the out of the money puts. So what you'll find in this type of a situation is you'll see that, like, an out of the money call will have a tent on the upside, and an out of the money put will have a tent on the right side. So what does that mean? What that means is, so you'll have a graph, and this will be the 585, and this will be the 713, and that's the tent or where you want it to finish for the call is there. And where you want it to finish for the put is there. And so with the double calendar, you're more flat deltas, meaning you don't want it to go up or go down necessarily, but you want it to move towards your short or end long strikes, because that's where the maximum profit is. So let's look at, like, now that we know that. So what happened to the stock? Well, come February expiration, so we always run it to the first expiration, that this expired worthless, and you still had value. The stock price remained pretty constant, and you still had a fair amount of value in the puts, and not so much in the call. So you were profitable on this one, because the front month you had theta, and the vega held out pretty good there. So does that make sense so far, Tyler?
Yeah, so maybe it would help to kind of explain, like, what's the benefit of a double calendar over a regular calendar, and it looks pretty similar to an iron condor in terms of the legs. So kind of what's the difference between those, and why would I choose to do a double calendar? And maybe we can compare back tests. That could be interesting too.
Yeah. So the answer is that if you just have a long call calendar, then you want the stock to go up towards your tent, and if you just have a put, then you want to go down towards your tent. And if you had your tent right at the money, you'd want it to stay there. So the double calendar is nice because it gives you a lot more range of movement, and it's not as risky.
So it's kind of similar to an iron butterfly versus an iron condor in that sense, right? The butterfly really sharpens it like a normal calendar spread would, and the iron condor widens it like a double calendar would.
Exactly. So like double calendar again, provides you with a lot more leeway. And so when might you want to use this one, right? So there's always a gotcha in there, right? There's no perfect strategy. So a long calendar strategy is long vega, right? So what that means is you're long the out months. So you want volatility, to hold up, right? So you want, so you might do this in a lower volatility environment where you might expect market volatility or the volatility of the underlying asset, in this case the SPY, to go up. So that's when a double calendar does well. So like right now the VIX, if it's over 20, that isn't that great of a time to, if you expect the VIX to come down, you're not going to want to be doing a double calendar because there's not that much vega in the shorts because those will end up losing money or finishing out of the money usually if the vol comes down, and you're just getting an expiration price. So it's all intrinsic. So there's no volatility there. So if the volatility goes up, that's going to benefit your longer term options. So that's typically a time when you want to do a double calendar. Does that make sense?
Yeah, it makes sense. It's one of your favorite strategies from some previous shows that we've done.
Yeah, it definitely is. And again, you want to do, there are favorite strategies, but there are also, good timing to do those types of things. So let's just look at, here's a double calendar that I ran before. And let's look at some of the monthly returns. So again, if you put it to 100, you can see where it makes money, where it doesn't. It's been doing pretty well lately. And that's a lot of because of volatility has been pretty good, rising volatility. So this is the this says iron condor, but this is where I changed an iron condor to a double calendar. But the best year, and this is why one of the reasons I like the double calendar is the best year was one of the hardest years to make money. 2020 March when the vol was down so much, and also 2008 when the market got creamed, the double calendar hangs on well. One of the reasons it is one of my favorite strategies is because when you've done I don't know, 1 billion strategies or however that we've done at ORATS, you'll see like a lot of them are not doing that great. They don't do that great during 2008 and 2020, but they kind of do well, in other months. Or, obviously a long put or a long put spread will do well in 2008, but they won't do very well in the other years. But this type of a strategy, it's had a couple bad years after 2020, and that's when volatility is coming down. So, I mean, lately or in 2025, the volatility held up pretty well, and so you were able to do pretty decently there. So that's I think that's one of the cases for the double calendar backtesting, what the show's about, where it performs well during those times, which that's what you're looking for. And we could look at this one. So this is another iron condor. This is that shorter term one. So the DTEs were 30 and then 10, 10, 30. So this one did pretty decently as well. same thing. It did well in 2020, did well in 2008. Again, the monthly returns, you could see that not as well because the last test had longer dated longs, and so that when the volatility really spikes, that does a lot better. So that's what you want to be looking at, Tyler, is like, where do you think the volatility is going to rise, and how much do you think it's going to rise, and that can help you set up this type of strategy.
Yeah, that's interesting. I was thinking about the optimizer and how you could structure some entry criteria around this, with as much focus as you're putting on the IVs.
Yeah. So, I mean, of course, the optimizer, you can get there from here. And what the optimizer does is it allows you to look at various data sets, contango, slope forecasts, FBs, and then I could sort these.
Yeah, this actually seems like I'm looking at the p-values. There's some pretty good ones in here. It's actually quite hard to find a good p-value, which is a good thing because strategies shouldn't easily beat the market. But it seems like a double calendar might be a good candidate for something where some of our indicators can help out here.
But you're right. I mean, this is like you don't normally see these types of strategies having such a low p-value, and we've talked about p-values before, and that's the probability of just a pure chance beating what your current settings are. So it's a very low chance, and so I would definitely save this strategy and then go view the strategy and be able to implement these in an automatic way. So we're also releasing auto trading. So that's that's one of the big benefits of this type of a system, Tyler.
Yeah, I'm excited for the auto trading. We've been doing some extra testing on it last week. We kind of demoed it last week, but it's coming out to you guys very soon. And yeah, it's going to be great to test out these double calendars and the optimized strategies kind of on their own in their paper trading environments and really forward test the ideas that we've been talking about.
Right. Yeah. So it's exciting. I think we should wrap it up, but it's exciting to have the double calendar now as one of our strategy drop downs. And, I would encourage people to go in and test these and, go use the optimizer to try to find the best time to implement these strategies. And like I said, a lot of these timings is super important for the double calendar. And the thing I like about it, the double calendar, is that it can benefit from looking at indicators, and it's also one of those strategies that doesn't have the same kind of payoff, or I should say profit months that the other ones have. And so that's why I think the double calendar is one of my favorites, and frankly why it's one of the more popular new strategies that you'll see out there, Tyler.
All right. Thanks, Matt. Yeah, that was a great explanation, and I'm happy we got to backtest some stuff and hear some insight into why you like it, and even touch on the optimizer a little bit. I'm excited for you guys to explore this updated dashboard and all the advanced features it now has with the custom backtesting. So
yeah, definitely.
Right. Awesome. Well, thanks, Matt. And thank you, Trader, for hosting us. We'll be back again next week, and hopefully we'll have auto trading and everything live by then. But yeah, lots of new updates in this new dashboard, including the double calendar backtest template now that you guys can get started on. So, all right, we'll wrap this up and see you guys again next week. Thanks, Matt.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.